Good afternoon. Welcome and thanks for joining us for our 2023 State of the Plan presentation. You can see that we've still got participants coming in on the call, but in the interest of time, I think we'll get started so that we can keep things on track. We've got a very diverse group of members with us today, which is great. We're so happy to have over 1,300 members registered for the webinar. Of course, this makes things a little bit challenging in terms of what we present. For those of you who joined us last year and provided feedback, thank you. We've used that feedback to try and refine our presentation this year. It was interesting to note last year, received feedback from some members that they found the presentation last year was a bit too technical, but we had others that really liked the dive into the technical investment concepts. So this year we've spent a little bit of time trying to find the right balance, and I'll say up front that the presentation it's primarily intended for all of our members who may need to make choices between the 4 investment funds that CSS offers. This is essentially all of our members, with the exception of those who are receiving the fixed monthly pension from CSS. For the pensioners on the call with us today, welcome. Very happy to have you join us. There is material in the presentation that I think you're going to find of interest, but I thought I should just give you a bit of a heads up that the section of the presentation on investments may not apply to you in the same way that it does for members who are responsible for their investment choices. A few housekeeping items. So we're recording the session. The members who couldn't make it today can still access this presentation, and of course the folks that are on it today, if you wanted to rewatch it, we'll be circulating the recording. Everyone except the presenter's audio is muted and video is turned off. So we're targeting to spend about the next 75 minutes or thereabouts with you. Approximately 60 minutes of presentation and 15 minutes or so of Q&A at the end. You can certainly enter your questions throughout the presentation in the Q&A section, and then we'll get to those at the end of the presentation. If we don't get to all the questions today, we'll follow up with an email to all registered participants afterward. That's going to likely take us 3 or 4 days to get that out to you, and we'll also make the recording of the presentation available at the same time. So with that, let's get started. There we go. So CSS is proud to play its part in advancing Canada's truth and reconciliation objectives. And to that end, let me take a moment to acknowledge the Indigenous peoples on whose traditional territories we live, we work, create, and cooperate. We acknowledge that the Pension Plan's office is situated on Treaty 6 territory, and that's the traditional territory of the Cree, Dakota, Nakota, and Saulteaux peoples, and the homeland of the Métis. We pay our respects to the traditional guardians of this land and honor their welcome and graciousness. And we recognize that you may live and work in a different traditional Indigenous territory. We encourage you to take a moment to reflect on your own acknowledgement and relationship to treaty and the land. Okay. Introduce our presenters for today. My name is Martin McGuinness. I'm the Executive Director of CSS, and I'm very happy to have so many of our members join us today. With me is Brent Godson. Brent is the Director of Investments and Financial Management for the plan, and Tammy Dove. Tammy's the Director, Member Experience at the plan. Our presentation today is made up of 3 sections. I'm going to look after section 1, and the purpose of this section is really to set the stage for section 2 and section 3. I'm going to talk a bit about some of the current risks that have our attention. These are things that affect us at the plan level, but also certainly relevant at the individual investor level as well. I'm also going to give you an overview of CSS's key investment beliefs. We have that listed in section 2 here, but I'm going to tackle it in section 1. And then with that background in hand, I'll turn things over to Brent to talk about how CSS approaches the construction of our portfolios to deal with those risks and those investment beliefs. Brent, once he's done his section, will turn things over to Tammy to talk about things at the individual member or investor level, and really at the overall member experience level. We'll regroup at the end to handle any questions, as I said, that arise, and we'll wrap up from there. Okay, so let's talk a little bit about market and investment uncertainty. I'm sure I don't have to remind you of some of the risks that we've been dealing with in recent times. Inflation, seems like everything is increasing in price lately. Gas, groceries, other essentials, rising interest rates. Folks with mortgages and other loans and debt are certainly feeling this one. On the flip side, people with cash in the bank are enjoying the higher rates. Volatility. We've certainly been seeing a lot of volatility in both the stock markets as well as in the bond and fixed income markets over the last number of years. Certainly been a challenging environment, over those last few years in particular. Geopolitical risk. Certainly the war in Ukraine is top of mind here, but there appears to be significant increased tensions around the world, for example, between the West and the East, in particular between China and its allies and the US and their allies. And recession, we can't forget that one. Will it be a soft landing? Will it be a hard landing? Has the recession already started? Some folks are saying the recession will start later this year. Some saying it'll start in 2024. Some saying we won't see a recession. The R word has been in the news for a while now. And if you try to listen to the so-called experts on this one, you'll come away perhaps more confused than where you started. I'll use the next few slides here just to make a few more comments about each of these, and with the intent to just set us up for the rest of the presentation. Increased volatility. It'd be easy to forget those times well before the tail end of the last century when we last saw real inflation increases. Over the past 2 decades or so, we've seen central banks, they've had room to lower interest rates, governments to print money, and they've certainly done those things. Generally, what's created an environment that's it's called a Goldilocks environment, where everything is just right for growth. We've seen at this, we've been at this long enough that we've seen investment professionals now and individual investors, who haven't seen periods of significant inflation in their entire careers, and so they've got limited experience dealing with these types of environments. Elevated inflation with recession, what we have currently, is a challenging investment environment for all concerned. And so the moves by the central banks in recent times to get inflation under control has led to significant volatility in the stock markets as well as the fixed income markets. And it's likely that we're to see more volatility on the horizon. Inflation risk. So, this is one I'm sure everybody on the call probably gets this one. Showing this in chart form, though, it really demonstrates how dramatic the increase in inflation has been over a relatively short period of time. The blue line in the chart is the full consumer price index, or CPI, basket. And the green line removes food and energy from that measure. Again, I don't think I need to spend a lot of time on this one. We're all affected by this one at the grocery store, at the gas pump. Certainly, it's something that's likely top of mind for many of us on the call today. If there is a positive here, it's that it appears that inflation may have peaked, but of course, it's not a certainty. Recession risk. So, nobody's particularly excited about a recession. It's important to realize that the economy does go through cycles, and recessions are a normal part of that cycle. The central banks of Canada and the US have used an inflation target around 2% as their benchmark. That's where they think the economy is in a healthy state, and so they typically make moves that are designed to keep inflation around that target. Of course, inflation is significantly higher than that target today. This chart might be a bit complex, but the key takeaway from it is that to get inflation back to target, so the dotted green line in the chart means that there has to be a large drop in the gross domestic product, or in other words, a significant slowdown in the economy and all the pain that that typically brings. So there continues to be a good probability that we'll see recession at some point in the near term. This chart is US based, but the situation in Canada is essentially the same. Okay, enough of the doom and gloom. Let me just start turning our focus to what CSS does to deal with these risks, and then I'll be able to turn things over to Brent. So as part of our investment process, CSS, the management and the board of CSS documents and regularly reviews our key investment beliefs. These are the core principles that underline our approach to investing, and they're the beliefs that guide our disciplined approach to investing, even when, or especially when, there's a lot of risk and uncertainty in the markets like we have now. The full list of beliefs is presented here, but I'm going to focus just on the three in large white text as they relate most to what Brent and Tammy are going to talk about. First and foremost, member outcomes are paramount. In other words, the long-term investment returns of your CSS portfolio and how that contributes to your financial security and retirement is of utmost importance to us. This, of course, guides CSS in our investment activities, but in a defined contribution pension plan like ours, we know that our members have a direct impact on their own retirement outcomes. And so Tammy's going to speak more to this when she goes through some of the tools, information, and resources and education that we make available to our members to better equip them to deal with this. CSS is a fiduciary, which is a legal term that means that we have a special relationship with and responsibility to our members because you have entrusted us with managing and investing your pension funds. Ultimately, it means we put your interests ahead of our own. And since we know we're investing member retirement funds, protection of capital is at the heart of our investment strategy. Doesn't mean we won't ever incur investment losses, but it does have a strong influence on what we invest in and the level of investment risk that we'll take. And Brent's going to speak more to this in a bit. Finally, let me highlight the various dimensions of our approach to diversification. Diversification includes the asset classes that we put into our portfolios, investing across the globe, being deliberate about the types of risk that we'll choose exposure to, how correlated those risks are with one another, and the resilience and the variety that they bring to our long-term investment returns. It also speaks to the approaches and the styles of investment management that we employ. So diversification is a real key part of our investment strategy. And again, I think Brent's going to provide some more insight on that in a moment. So hopefully this sets us up for the balance of the discussion. And so let me turn things over to Brent now.
Okay, thanks, Martin. What I hope to do in this next section is talk specifically about two of those investment beliefs that Martin mentioned. First of all, diversification, and then protection of capital. I want to talk about how we actually incorporate those into our investment portfolios or through the construction process. So, and then what I hope to talk about is just more specifically how our balance fund is positioned for some of those market risks or uncertainties that Martin mentioned: inflation risk, volatility, and recession risk. But first, portfolio construction. This is really about how we build robust portfolios to mitigate risks while still achieving our return objectives. On this slide, you have an overview of the investment cycle that we go through. And it occurs about every 4 to 5 years. We do what's called a portfolio study or a strategic asset allocation study. In each of those studies, we use the latest assumptions for future asset class returns, asset class volatility or risk, and correlations between asset classes. Correlations simply being how certain asset classes move relative to each other in similar market conditions. The plan and its consultants, Mercer, consider possible additions to or subtractions from the portfolio to improve the portfolio's return and or risk profile. We do numerous iterations of possible portfolios. We model those and compare them to the existing asset mix and to each other. The comparisons are based on a number of risk and return metrics that we'll look at in more detail in a moment. And additionally, each possible portfolio mix is stress tested against a number of economic scenarios. So, this is a slide, an actual outtake from our portfolio study. And again, it deals specifically with that diversification belief that Martin mentioned. On the left-hand side of this slide, we have our strategic asset allocation. So it identifies how we're diversified across various asset allocations. This as at 2020, when we started our last portfolio study. You can see it's relatively well diversified across equities, fixed income, and real estate within the portfolio. But we don't just stop there. We actually dive deeper into the diversification within the portfolio and actually determine what's actually contributing to the risk within that portfolio, as well as the return within that portfolio. And those are the two other pie charts that we see in the center of this slide and the upper right of the slide. So in the center of the slide, we see what's actually contributing to risk or volatility within the portfolio. And it looks much different than the asset allocation pie chart we see on the left-hand side. You can see here that at this point in time, the equity risk premium was actually contributing about 90% of the overall risk within the portfolio, even though our allocation to equities was only about 55% of the portfolio at that time. Similarly, on the return basis, you can see the return contributions in the upper left-hand pie chart, again, is dominated by the equity risk premium, contributing about 75% of the returns within the portfolio. Again, even though it's a much smaller portion of our asset allocation within the pie chart. So hopefully the point here is we're trying to demonstrate the rigor that we go through to actually understand the diversification within the portfolio and ultimately diversify away from the dominance of that equity risk premium within the balance fund. Another outtake from our portfolio study, this is really focusing on that second investment belief that Martin mentioned, protection of capital as a fiduciary. I think this shows in the left-hand side of the chart the types of risks that we're actually monitoring and looking for improvement within the portfolio. The first risk is the risk of not meeting our return objective over a 5-year time horizon. That return objection is CPI plus 4 or inflation plus 4% over that time period. So we certainly want to make sure that we're achieving our return objectives, but at the same time, we're mitigating downside risks within the portfolio. And that's the next set of objectives that you see on the left-hand side here. We actually have 3 metrics that we look at for downside risk: expected average loss in the worst 5% of outcomes for the portfolio. We obviously want to minimize those expected levels of losses. The number of negative years returns over a 20-year period. Again, the objective is to reduce the expectation for negative returns coming out of the portfolio. And then third, we want to look at the minimum 1-year return in a stress scenario. So how bad can portfolio returns look in any 1-year period in stress market environments like a pandemic downturn? We also look at absolute risk or volatility of returns. We measure that by standard deviation of returns. So this is really trying to measure how volatile the balanced fund performance is, how high and low are the swings in performance over time. We actually like to smooth out returns as much as possible over time and actually reduce volatility. Factor concentration, that goes back specifically to the previous slide, looking at diversification. How can we try to minimize the reliance on the portfolio of that equity risk premium for returns and reduce the overall volatility or risk within the portfolio at the same time? Liquidity risk, obviously we have to let members leave the plan at certain point in times or reinvest their portfolio in money market instruments or other funds. We need certain amounts of liquidity within the balanced fund to be able to do that. So we measure liquidity over in both normal and stress market environments to try to ensure we have that ability or liquidity within the portfolio. And then finally, on a fee basis, we look at each of these potential asset mixes that we're modeling relative to our current policy and compare the fees that it costs to access those various asset mixes. This next slide is quite similar. Again, a little bit different view taken directly from the portfolio study. Again, looking at all those various risk metrics, comparing them across current policy to alternative asset mixes. But in this one, you can see that we're looking at those return and risk objectives in two different perspectives. One is on a 5-year shorter term time frame. The other is on a 20-year time horizon. And we're capable, as you can also see from the chart here, that we're able to identify which mix performs best within that certain objective. Those are highlighted in green, and which mix performs the worst in the particular objective. Those are highlighted in red. Again, all of this to try to improve the risk-adjusted return of our balance fund. And finally, as I also mentioned previously as well, not only do we measure all these particular asset mixes against a number of risk and return metrics, but we also stress test those various asset mixes against a number of economic scenarios. And you can see those economic scenarios mentioned here, whether it's ideal growth, inflationary growth, deglobalization, lost decade, financial crisis. The one that's emphasized on the bottom is the latest addition to our stress test, which is kind of a global warming stress test, consistent with our belief in incorporating environmental and social and governance objectives into our portfolio. Again, the overall hope here was that you get an idea that when we're building our balance fund and determining which asset classes to include in that fund, we have a very rigorous routine that we go through on a regular basis to test those potential portfolios against a number of risk and return objectives, as well as a number of stress tests. One last piece here, just to ultimately show you the outcome of our last portfolio study. We've kind of run full cycle now. I mentioned it started in 2020. Since that point in time, we did all the modeling, all the iterations of potential asset mixes, came to some conclusions. Ultimately, those conclusions led us towards doing due diligence searches for new potential managers. Those searches ultimately led to hiring some additional managers and funding those managers. The portfolio study actually recommended additional or new private market infrastructure be added to the portfolio, as well as private market real estate. Of course, that means we have to take away from somewhere in the portfolio. We did so by reducing both public market equities and bonds. with that, that takes us to the next section that we wanted to cover, and that's how is the balance fund currently positioned for some of those market uncertainties that Martin highlighted, particularly inflation, higher volatility, and recession risk. So if we start with inflation, I don't think we have to look any farther than those recent additions that I just mentioned, the addition of global direct infrastructure and global direct real estate to the portfolio. We've increased those real asset weights to close to 20% of the balance fund. That increased in exposure, and both of those assets, strong inflation hedging characteristics, will really improve the real inflation adjusted returns in the balance fund going forward. And to try to demonstrate that or talk about that a little bit more, I have a chart here from BlackRock, another of our investment partners. This is a chart that shows asset class returns in high inflation environments over the last 20 years. It shows both high inflation, high growth environments and high inflation, low growth environments. And you can see that the real outperformers in both of those high inflation environments are, first of all, global direct infrastructure, and then second of all, global direct real estate, outperforming more traditional public market global equities and public market global fixed income by various amounts in either of those inflationary environments. So, just to go back, we've made allocations to JP Morgan infrastructure in July of 2022. We subsequently made a commitment and funded an investment in IFM infrastructure, global infrastructure, in January of 2023. We had an existing investment in Canadian private market real estate with TD Greystone, and have since started to allocate some of that Canadian allocation globally to a fund with TD Greystone as well. And finally, the last funded allocation that we made was April 5th to UBS Global Real Estate. So again, increasing that weight to 20% of the balance fund, I think, should help protect the portfolio from an environment which includes in higher inflation going forward. The other thing that we can look to in terms of inflation is our equity portfolio. We've talked about this in past webinars, but our equity portfolio does have what we call a value tilt, which means the stocks that we include in that portfolio or that are included in that portfolio traditionally are very concerned about valuations and valuation risk. That value tilt that we have in the portfolio tends to outperform in high inflation environments. And again, I have a chart to try to demonstrate that, this one from Research Affiliates, and it shows how the value factor or those value tilts have outperformed relative to broad market benchmarks or broad markets over the last 70 years. So in this chart, the outperformance of value is on the horizontal axis, inflation rates on the vertical axis. So you can see that in high inflationary environments like the 1970s or the 1980s or 1940s, that value outperformed in those types of environments by in excess of 5% to almost 10%. So again, another factor that we believe will help performance of our funds in an inflationary environment. If we switch gears now to one of the other risks that Martin mentioned, and which was volatility and recession risk, what I've done here is give a quote from one of our investment partners, again, Wellington Management, that I think conveys our beliefs on how we structure our portfolio to deal with those particular risks. So The quote reads, "Our research strongly suggests that mitigating downside risk is essential to achieving long-term investment outperformance. This finding is rooted in the power of compounding, a mathematical phenomenon that works in an investor's favor in bull markets, but against the investor in bear markets. In short, $1 of alpha or outperformance in a down market is worth more than $1 of alpha in an up market." And Wellington has a couple of slides to try to help understand that, how that outperformance or that downside protection actually leads to outperformance over the long term. So a couple of charts here. Let's look at the one on the left first. Again, this is a hypothetical portfolio that would be able to capture not all of the upside markets, but 95% of the upside, but bias the portfolio towards downside protection, protecting 85% in down markets, or only incurring 85% of the losses that markets incur. This is in the S&P 500, which is the US large cap equity market. It's over the past 80 years. And you can see that hypothetical strategy that protects on the downside actually would generate over 3 times the performance of the S&P 500 over that same period. If we look at the chart on the right-hand side, we maybe can get a little better understanding of what's actually happening or where that outperformance comes from. Again, it's the hypothetical 95-85 portfolio. But here we're looking at a shorter time frame, about a 10-year period between 1996 and 2017. The gray bars are in this time frame indicate where we had recessions in the market. The first one being the dot-com area recession, the second one being the great financial crisis. And the line in this graph is really cumulative outperformance of the hypothetical portfolio relative to the S&P 500. So we can see again over the full time period that the hypothetical portfolio is outperformed at a level of 1.3 to 1. So outperformance for that portfolio. But if you take a closer look at the line, you can really see where that outperformance comes from. And it's during those recessionary periods when that portfolio is providing that downside protection. That's really where you see the acceleration of outperformance relative to the broader marketplace. So probably the best way to show how our own balance fund performs in those same types of market is to look back to that same dot-com era, pre and post dot-com recession, and see how our portfolio performed during that environment. The reason we've chosen that is because most of our partners and many economists believe that particular period in time resembles this current environment that we're in right now and have been experiencing over the last 4 years. So if we look at the balanced fund performance, we can see that in 1980, 98 and 99, this was a period when market valuations or stock prices in the market were at extremely high levels. In fact, higher than they had been in history. And during that time frame, again, our portfolio, consistent with now, had a tilt towards value, which has concern for valuations or stock prices overall. And in that type of environment, the portfolio and the balanced fund in general underperformed in both 1998 and 1999 by a cumulative total of over 10%. But as 2000 rolled around and we saw market valuations start to normalize, we can see our portfolio start to outperform again. As recession hit in 2001 and 2002, again, our portfolio continued to outperform in that environment, and in fact, outperformed all the way up to the financial crisis. Similarly, in recent years, we've seen a similar high market valuations as we did in the pre-dot-com era. So in fact, valuations or stock prices are second highest only to the dot-com era through 2018 through 2021. Similar to that pre-dot-com era, markets are very concentrated. In 1989, 1998, 99, and 2000, they were concentrated in the technology sector, particularly in internet stocks. In 2018 to 2021, we again saw a concentration within the tech sector. Think mega cap stocks in the US. Here in Canada, think Shopify. But again, as 2022 rolled around, we saw a change. Market valuations started to normalize again, largely because of rising interest rates in the marketplace. And again, we see our portfolios start to outperform. So the big question here is, what happens from this point on? Obviously, it's difficult to predict, but we do think our portfolio is well positioned for the future. The next thing I want to talk about, again, is diversification, that other investment belief that we had. Again, I've chosen a quote from another institutional investor, Russell Investment, to try to convey a similar belief to our own. So the quote reads, "In recent years, Russell Investments has consistently advocated for investors to consider a global multi-asset approach to investing for a multitude of reasons. Chief among them, our belief that doing so puts clients on a smoother path towards meeting their goals. While the objectives of multi-asset strategies may vary, some are designed specifically to help provide investors with better downside protection while providing the growth that they require." So this is similar to a journey that CSS has been on for the last number of years, transitioning from a very traditional 60% equities, 40% fixed income portfolio, one that's, by and large concentrated in Canadian investments, to a much more global multi-asset approach, a portfolio that's invested not only in equities and fixed income, but in real assets, including infrastructure and real estate. So I don't think there's any better way to demonstrate that than looking at the asset allocation chart for the balance fund. This is as of March 31st, so it actually doesn't include our last investment in UBS Global Real Estate. But you can see that, again, we're diversified not only across asset classes, but geographies. We're in both developed and emerging markets, sources of risk and return, as we spoke to earlier, both in public and private markets and across investment approaches and styles. That is a level of diversification that I believe you would have a very difficult time trying to replicate in the retail marketplace, and something that CSS's scale really allows us to deliver to the membership. So hopefully that gives you an indication not only about the rigor we go through to incorporate our investment beliefs into our portfolio construction, by and large designed to mitigate risks in investment environments like this. I spoke specifically to how the balance fund is positioned for some of those market risks. I think it's well positioned for going forward. So with that, I'm going to turn it over to Tammy, and she can talk about some of the tools and education, and actually how members should deal with these same market uncertainties and risks. Tammy, I'll turn it over to you.
Thank you, Brent. All right. Martin and Brent, thank you so much for providing that information to the membership about taking them through the different risks that we are all aware of and are monitoring, and walking them through how we construct our portfolios. My apologies, my screen just went blank. All right. So you are taking time out of your day, and I really appreciate that. In the next 10 slides, I'll be talking 20 minutes or so, 15, and I'll walk you through the different tools and education that are available to you as members. We're going to cover two key concepts: having a plan and sticking to that plan. There's a benefit to having a plan, and I mean plan as in plan for your investments, plan for your retirement, plan for whatever it is you are going to tackle in the upcoming week. There's benefits to having a financial plan. The grand percentage of people, or a vast majority of people who have a plan in place, truly do feel better about their investments and truly do feel better about where they are headed with those investments. All right. Okay. When we're talking about preparing your plan, let's start talking about your risk tolerance level. There's a difference between your risk tolerance and your risk capacity. Markets do go up and down, and as Brent already described and gave us some great numbers and visuals on, your accounts do go up and down because you're invested in the markets. Risk tolerance deals with how you're mentally and emotionally able to handle that risk. My apologies, guys. I gotta move you. Sorry, coming with me. There we go. The screen went blank. There we go. Okay, risk tolerance deals with that willingness to take on risk. There's a tool online that you can use. All of the membership can go online and use this tool. It's called a risk tolerance estimator. It's designed to walk you through a couple of questions. It's very easy to use, and it'll give you a recommended portfolio using the 4 different funds that you have here with your CSS pension plan. At the end of the day, when it comes to your risk tolerance, what it's really asking you is how much risk can you bear and still sleep through the night? Risk tolerance definitely varies by age, by your financial situation, by your investment goals. And this tool can help you figure out a risk tolerance or an estimated risk tolerance. Risk capacity, that's a different little beast. Risk capacity is your ability to take on risk without hurting those long-time goals. Risk capacity is your ability to take on risk. An important metric when you're thinking about your risk capacity, or at least one of them, is your net worth. You can look at how much assets you have, how much liabilities or debts you have. Sometimes one could say that if you have more assets and just a few liabilities, you might have the ability to take on more risk. That's your risk capacity. However, the reverse to that, if you have just a few assets and a lot of liabilities, you might not be able to take on as much risk. There are, of course, other factors, though, when it comes to your risk capacity. We're talking about things like time horizon. We often see the younger members, the people who are just entering their work career, take on more risk, partly because of that time horizon. They have a little ways before they're actually at retirement or living through their retirement plans. Throughout our lives, we're going to find ourselves in a place where your willingness to take on risk, your tolerance to risk, and your capacity to take on risk might not jive. Certainly a good tool or a good thing to keep in mind when you get to that place in your world is that you really do want those two aspects to align. You really want to invest in a way that you're aligning with your risk tolerance and your risk capacity. This tool, again, just to go back to the tool itself, having a plan, this will help you, the risk tolerance estimator will help you determine your risk tolerance and help you start to navigate how you might want to invest in this pension plan. Another tool that you have available to you is your retirement planning tools. This tool, the one that I'm talking about here, is available online to all of the members through their portal. And this tool gives you a couple different inputs that you're going to want to look at and use. It gives you a readiness zone, so it lets you know, are you on course, off course, on track? It'll give you some suggestions if you are off course as to how you can get your plan back in place. The course corrections are actually fairly simple. You could save more. You could spend less in retirement. You could retire later. And you can invest differently. We're going to talk about that in a little bit. Having a plan in place, just as knowing your risk tolerance is so important, and investing that way that aligns with your risk tolerance. Having a plan in place for your retirement, how much to save, how much am I going to spend throughout my retirement years, it gives you this sense of ownership, and you're empowered to to truly own your financial future. There's some benefits to having a plan. You don't know what you don't know, and that's the truth, no matter what age or stage you're at. The tools such as this type of retirement planning tool or other ones can actually trigger some good questions for you and answers that you just haven't considered yet. Another big one about having a plan and eventually sticking to it, and that's where we're going next, is that it can reduce your financial stress. With reduced financial stress, you actually improve your mental and physical health, and that's truly important too. That peace of mind is important as you're navigating your financial life. Remember I said that one of the ways that you could course correct is to invest differently. However, I actually started with invest in such a way that aligns with you and who you are, your investment tolerance. Keep that thought in mind. Most of our membership are in the balanced fund. And that balanced fund that Brent described, it is this amazing little balanced fund that has a bunch of assets across all those, the assets, the geographies, the different markets, the different time horizons. That balanced fund is working really hard to balance out that downside risk for you. So it doesn't surprise me that most of our membership is in the balanced fund. Some of our members have tacked on some of the other funds, the equity fund, the money market fund, perhaps the bond fund. So they are definitely using those 4 different funds. Most of them are in the balanced fund. Having a plan for when it comes to when you think you should make an investment decision, what sort of triggers are going to cause you to make that investment decision is an important thing to pre-think about. Brent did describe as well some of the things that CSS is doing to navigate where we think the future is going, inflation, recession, maybe not, and all of those investment strategies that we're doing to try and, again, protect that downside risk. You also have to have a similar plan for when you might or might not make changes to your investment decisions. When it feels absolutely critical that you have to make an investment change, take a step back. It's best to look at to reflect on your investor profile, on who you are as an investor. It's best to look at your risk tolerance, your risk capacity, your ability to take on risk, and talk to some people. Our advisors, I'm going to introduce you to them here in a bit. Our advisors are here to help you with some of those questions that come with investing and help you work through some of the emotions that come with investing. That being said, when it does become necessary to make an investment change, you can do that online. There's an online tool through your portal that it's very simple to use. It will walk you through the risk tolerance estimator, and it will walk you then through the different steps to change your investments to align with your needs. Those are just 3 of the tools available to you. So the risk tolerance estimator, the online retirement planning tool, and the investment instruction tool that actually helps you change your investments. There are other tools available at CSS, and I encourage you to go on the website or give us a call to learn more about them. You have your plan. You know what your investment style is. You know how you're going to respond or react if you think that you need to make changes to your investments. And you have a written plan about retirement planning, what you're going to do before, in, and through retirement. Now let's talk about sticking to that plan. I want to make sure that you know that it's really important that you take a moment to reflect on how you're going to respond when things start to get sticky and you realize that you do want to make some changes to your plans. That's what we're going to talk about here. We all want to make rational decisions. Sadly, we don't. We are humans, and we often have very strong emotions, anxiety, fear, greed, love, excitement, anger. And those emotions are some of the key reasons why we don't really act rational all the time. Sticking to your plan will likely have positive impacts on your financial wellness, and knowing how to stick to the plan can help you avoid some of the negative impacts that could happen. CSS, actually Brent did start to talk about the CSS advantage, and where he was talking about that strategic asset allocation management. That's a really big advantage to being a member of the society and a member of this plan. Having your assets invested in some of those institutions that you wouldn't have access to is a very big advantage to you as we navigate your plan going forward. The next 4 slides talk about behavioral biases. These are 5. There's many. You can go onto the website And there's some really good articles on there that talk about each of these. The recency one hasn't come out yet. 2 slides from now, we're going to talk about overconfidence and fear of missing out, or FOMO. We're going to take a version of that called FOL, but we'll get there. Loss aversion, herding, and recency. I'll just cover those real high level here on this slide. Benjamin Graham. Now, he's a famed investor. He once said that investing isn't about beating others at their game. It's about controlling yourself at your own game. He went on to give us some further advice. The best way to measure your investing success is not to judge yourself to see if you're beating the market, but by whether you have put in place a plan and have put in place the behavioral discipline that is likely to get you to where you're trying to get to. And we're all just trying to get to retirement and that financial security in retirement. As I promised, I was going to talk about loss aversion, herding, and recency on this slide. Loss aversion. Now that actually touches on how bad, when you lose money, how bad that feels compared to when you earn money, how good that feels. We feel things that are bad and with much more pain. For example, the balanced fund had 3 positive years in 19, 20, and 21. We saw that on Brent's slide, 11, 4, and 9%, really positive years. Yeah, we got some phone calls and very happy people, but nowhere near like the calls that we got last year when the 2022 return was minus 5.8, right? That just felt worse, even though there was 3 years of really good returns before that. So loss aversion is that feeling that we get when we feel losses more. Herding sounds a lot like what it is. We tend to follow, we're humans, it's in our nature. We tend to follow certain groups of other people's, and we do what they do. The problem with herding, especially when it comes to investments, is that a small group of people made a decision based on their amount of evidence, and then a larger group of people followed those decisions. I think Spotify perhaps might be one of those. What you find there is you see a lot of panic buying and panic selling. They're trying to chase a return in the market. Recency, not to go in this one too far, but I wanted to give the example for the recency. Recency is, as humans, we tend to put more attention to what we see in the news today versus what we know to be true over a longer period of time. So we give more weight to what we know about today. Here's a good example of that one. When Jaws came out, back in 1975, the Jaws movie came out, was a blockbuster. Statisticians noticed that a significant amount of people stopped swimming. And that's simply because it's not that there's suddenly truly more shark attacks happening, just it was top of mind. It was the first thing in people's minds. It was the more recent news. And even though evidence showed otherwise, people were responding to that very recent news by trying to make sure they weren't going to get eaten by sharks. The next slide, this one, sticking to the plan. Again, remember we had that plan and we're trying to stick to it. And these slides here, they're just to give you some tools in your back pocket so that you can sit back and question yourself when you're about to make a financial decision. Recessions happen. They will happen with your fund. They have happened with your fund. They will happen again in the future. And they tend to not be horribly long. They're still, like there's this one back in 1975 or 1875 or so, and the one in 1929, but the other ones, maybe 18-month average. So those 18 months, that's where the recession is happening, and then there's a recovery. This concept here that I'm trying to warn you about, this behavior, this emotional response to investing that can happen, it's related to fear of missing out in part. I'm going to have to talk about that one first. So the fear of missing out is trying to chase a return that you see about to happen and you think you want to get that. So you start to chase that return. The fear of losing everything is actually a bigger fear. And that's when you start to see the markets go down. And we've seen it a little bit with the strong emotions from people when they're calling us and working with our advisors. They're afraid of losing everything. So they take all their money from that balanced fund and they put it in the money market, but they're going to miss out on the returns that are coming forward. They might be selling high. That's actually the risk here, is you're going to be buying high and selling low. And that's a recipe for disaster. Some of those key things that you're trying to keep in mind as you're looking at your investments and you're navigating your plan and you're trying so hard to stick to it, is taking a moment to step back. Approach investing with a consistency, with a strategic approach, and just step back and truly do look at the evidence before you. In our funds, we are very diversified and we try hard to protect that downside risk. And if you sit through those recessions or those moments when the downside risk is happening, the fund is designed in such a way to prevent or to protect your downside risk. This is an interesting one. We've all heard about this one. You've heard about people saying it's about time in the market, not timing the market. Now, what this bias is talking about is being overconfident. We all think that we're smarter than everybody else. That's a very normal human approach. Again, we definitely think that we're smarter than the other drivers on the road. We're smarter than the people who are at grocery stores. We just have this natural instinct to think that we're smarter than everybody else, at least 50%. Let's give it a baseline. Of course, we know that's not true. At the end of the day, we're not smarter than everyone else, and we definitely have an opportunity to learn from other people, but we do get overconfident because of that. If somebody just stayed in the market, this example here, fully invested during that time period, they'd have about 7% return. Over that same year, in this example that you see on the slide, if the person had missed just 10 days out of those 365 days, they lost 2.4% in this example. That overconfidence by thinking that they can time the market didn't work out so well in this example. And that holds true in most situations. Again, if you're finding yourself that you do want to make changes or respond emotionally to the investments or to your world, it's about taking that step back, even seeking the advice or input from other people. Our advisors here are really good at behavioral coaching. It's something that they're well versed in. And of course, there's opportunities online and other trusted financial advisors. This visual tries to help you see the cost of those emotional responses, of those behavioral responses to investing. One factor in this visual is the rate of return that an investor might receive, depending on which portfolio that they're in. Another factor in this visual is the rate of return that the actual portfolio or area of market actually returned. And what this visual then does is it takes the investor's portfolio or rate of return, subtracts the fund rate of return, and it illustrates for you if that investor was able to mirror the returns or get better than, or not even reach the same rate of return had they not been influenced by their behavioral biases. And what this goes on to show us is that that investor who's human and doing their own behavior biases and living their life and investing such, they didn't mirror, they didn't meet the portfolio had it just been left to be, and nor did they beat it. It's a good way to just see the summary of how those visuals, of how those behavior biases work. Okay, well, we've talked about having a plan and sticking to it. Who can help you, right? We are emotional beings and we like to talk with people and work with people and use the tools that are available to us. We also are adults and like to know where we can go to get help. CSS has a team of professionals, from investment people, accounting people. They also have a team of advisors. Some of you have met these people on retirement income workshops. Some of you have called in and talked to these people. Thank you. And this is Chantel, that's Rhonda, there's Marilyn, and there's Jessica. And CSS has invested in these people so that they can be part of your world. These people are all financial planners or certified financial planners. And there's a lot of now well-known research that indicates that people who work with a financial planner end up in a better place for the most part than those who aren't working regularly with a financial planner. Those same people are also feeling better about their finances and have a better sense of financial wellness and are able to navigate the bumps that come along with investing. The advisors, again, there's the benefits of financial advice and financial education is now well recognized. Speaking of GDP, Martin spoke about it a little bit earlier. If just 10% of Canadians actually worked with a financial advisor, like one of our advisors, by 2060, there'd be 2 billion in household wealth. There'd be 900 million in real GDP. Those are some real numbers by just a small amount of people working with financial advisors who are strong in these skill sets. Behavioral coaching, those emotions that come along with running your plan and sticking to your plan. Behavioral coaching is what some of our advisors are very good at helping people through, and we have helped them through the members through their different investment considerations. Spending strategies. When you speak with an advisor here, they can help you figure out how to draw down your pension income and your other incomes if needed using some tools. They help our members look at their asset allocations within plan. And this is a very popular one. They also talk about optimizing CPP and OAS with the members. They talk about that because the members are asking for that. Working with an advisor is not a one-hit wonder, nor is it going to benefit you overnight. It does take a bit of time, but not years, not decades. 4 to 6 years of advice, 4 to 6 years of working with somebody who is well-versed in these types of strategies. Some research indicates that you can have 2 times more in wealth. Those numbers go up from there. 7 to 14 years, 15 years, and it just goes up from there of having a different amount of wealth. These are tools that are available to you. The tools that I discussed, there's other tools and our advisors to help you navigate these markets that we're going through and that we will continue to go through. And with that, I will pass it back to Martin.
It's great. Thanks, Tammy.
Thank you.
Thanks, Tammy, and thanks, Brent, for the presentations. I thought that's hopefully our membership got a lot of value from the discussion. We're going to turn to the Q&A section. There's been a few questions come in while the presentation's been underway. And there's some good ones in here, and I think there's a couple. I think, Brent, I'm gonna pick on you a little bit first, just because I think some of these questions lead into maybe some of the nuances around some of the information that you provided already. And so I'm going to just start with the first one asking about balance fund performance in compared to the markets, I guess, or other investment vehicles out there. So members asking 2022, they saw as a bounce back year for other investments that they had outside of CSS. And so they wanted some more insight into our loss of 5.86% on the balance fund. And I think obviously it'll refer to the outperformance, I guess, even though there was a negative sign in front of it, there certainly was outperformance on the balance fund in 2022. But maybe just get your comments, Brent, on that.
Yeah, it's difficult to draw comparisons without understanding what those other investments actually were. I think we went through that. We actually did outperform our benchmarks in 2022. I think if you looked at, Canadian equities, they were down about 5.8%. If you looked at US equities, they were down based on the S&P 500, over 12%. Fixed income here in Canada, Canada Universe Bond Index was down over 11.5%. So some of those major asset classes, 2022 was a very unique year, and it was one of the first years that we saw both equities and fixed income returns around the world in negative territory. So, I think our actual performance was very positive relative to benchmark, positive relative to some of our peers. So I'd really have to understand, given, what markets did broadly in fixed income and equities, I'd really have to understand better what particular investments he was exposed to, or he or she was exposed to.
Right. And maybe just a follow on here, Brent. I've got a member asking, can you please comment on how the balance fund is currently performing relative to benchmarks? Maybe just yeah, I'll turn it to you just to comment on that.
Yeah, so I think kind of a similar market environment to what we saw in 2020. We underperformed during that particular period relative to benchmarks. Again, it was in a market environment. If you think of the US probably being the best example, although this occurred globally around the world, where very speculative, increasing market valuations really centered on a handful of companies, particularly in the US. Think of the FANG stocks or the Facebook Metas, Apples, Amazons, Googles, more recently the Nvidias, really a speculative type market. And again, our portfolio isn't really designed to keep up with those speculative high valuation type markets. It's more fundamental based, really concerned about market valuations getting too high. It tends to underperform in those type of environments, and it is right now in this kind of AI focused market in the US in particular.
And actually, that's a very good segue, because I have a question here. How exposed is CSS to investing in AI?
Yeah, so we again have more broad market exposure. Again, if you're looking at the US marketplace where really this AI phenomenon exists, it's really started with Microsoft and their investment in ChatGPT. NVIDIA has kind of followed suit with some outperformance in terms of their semiconductor market. But we've seen it, basically anybody who mentions AI now tend to do well in the stock market. But most of that performance is again concentrated within that large group of mega cap stocks. We're much more diversified in the US, although we have exposure to those stocks. They're not at the 6 to 7% weight that Apple is in the S&P 500, or similar type weights that those stocks are in the US marketplace. So we are underexposed relative to what's happening currently in AI in the US market in particular.
Great, thanks, Brent. And maybe I'll stay on the investment line here for just a bit more. A question around, so you talked about portfolio risk analysis, or the portfolio study being done every 4 or 5 years. Maybe you can talk a little bit about what's done in between those periods. So the question here is just around, do we plan and review the portfolio risks more often than every 4 and 5 years?
We don't do portfolio studies or strategic asset allocation studies generally more often than 4 years, although there would be times when certain instances that we will need to do an additional study. But generally, that's the cycle that we go through. And so if we look at that 4 to 5 year time period, that's starting the process of modeling, looking at alternative asset classes, modeling all those asset classes and various asset mixes, revising those and remodeling again and again through a number of iterations. Then that we make the decision that we have to make a change within the portfolio. That generally involves searches. That means that we work with our consultant again to do diligence within all the managers that were in that particular asset class, researching those, refining that list down to a potential number of candidates, interviewing those candidates, doing further analysis and research, and then ultimately making a decision. From there, there's the actual funding stage where we're negotiating investment management agreements, signing contracts, and getting to the point where we can actually commit to and fund those investments. In things like private market assets, that tends to take longer than public market equities. So that what may seem like a relatively simple process is actually does take that full 4-year time frame to go start to finish.
Yep, thanks. And I think that speaks to, you were mentioning earlier, I think about, sort of the long-term view versus sort of making tactical short-term investment changes, right? So that's great.
Yeah, again, one thing I should point out, when we're looking at building these portfolios and doing these studies, it really is primarily over a 20-year time horizon. So we're not so much concerned with what happened in any particular year. What happened is in a particular year tends to have very little effect on what's happening over the next 20 years.
Right on. And then there was just a question for clarification here. You talked about, stress market environments or stress testing the mixes. Maybe you can just give a little more insight on what is a stress market environment, or maybe an example or two of what that means when we're stress testing a portfolio.
Well, in each of those particular scenarios, those actually existed in history.
Yeah.
So we're able to go back, or our consultants are able to go back and actually dive deeper into the characteristics of, for example, the Great Financial Crisis. What actually happened? How did asset classes perform? What happened with inflation? What happened with interest rates? How did equities perform? How did real assets perform? How did fixed income perform? What happened with volatility? All those sorts of things we can look at through the data and actually reproduce those again with the portfolio mixes that we're looking at to see how that particular mix would have performed in that particular environment.
Good. Thank you. And let me turn to Tammy for a couple here now. So we've got a question about any cost, Tammy, to accessing the certified financial planners that you talked about at CSS. Oh, I think you're muted.
Thank you. Is that better?
Yep,
okay.
It is.
Okay. Thank you for the question. There's no cost to accessing the financial planners. They're a resource that the board and the delegates and the management team thought was really important for our membership to have, that unbiased access to unbiased advice and education was important to everyone.
And I see that there was a question on here. I think it's probably been answered directly with the member, but I think it's useful for everybody. And that's in terms of what happens, if a member passes away pre-retirement or even post-retirement. The question was around beneficiaries, or just basically what happens to the funds if in those kinds of environments.
Excellent. If a member does pass away, whatever's in the individual's account does go to their beneficiary, be it their spouse or whoever they've named as the beneficiary. So that works out pretty good that way.
Yep. And we have a suggestion here. Can you please create an online method that's easier to update and change beneficiaries? And maybe I can just talk a little bit about, we didn't get into this, but one thing CSS is working on and will be working on over the next year or two is I'll call it an overhaul of our pension administration system and systems. We'll see a new member portal sometime possibly later this year, but more likely in 2024. But certainly all of the interactions that members do and want to do with us online is in that process. And so we're aware, and part of it is just historically in the pension world with pension legislation and regulations, it's driven us to have to use paper-based functions. So this has been one of the maybe benefits that's come out of COVID is that both us, but also our regulators and the folks that keep an eye on what we're doing have realized that digital works and people actually a lot of people want to interact that way. And so some of those rules that were in place before that forced us to use paper have now been changed just recently. And so we're taking that opportunity to incorporate workflows and just trying to make things more simpler, I guess, to interact with the pension plan. So, short answer on that one is just stay tuned. We've got a lot planned here that we're working on actively right now, and we're looking forward to sharing that with the membership in the near term. So, good. I got one response there. Good to hear. So that's awesome. Okay, we are getting to kind of our time limit that we wanted to respect, and there are some questions here still on the list. We will send these out. I see a quick one here. I think it's a quick one, Brent. Does the plan have any investments in China? And there is another one here too, just talking about risky investments, which I think is a cryptocurrency question here. I wonder if you can just maybe comment on those two before we wrap.
So yes to the China investments. We are invested in emerging markets. China is the largest piece of emerging markets out there, and we're invested both in equities and fixed income in those markets. Cryptocurrency, no. It's still our position that cryptocurrency is not yet a suitable institutional investment. The volatility in that marketplace just isn't suitable for our plan in particular.
Okay, well, that's great. Okay, as I said, I want to respect everybody's time, so I think we'll wrap right now. A reminder that we will send a link out of the recording along with the recap of the questions that we didn't get to, and we'll provide those answers. And a reminder, there were a couple questions in here that I kind of avoided because they seemed a little maybe personal, I guess, to me. And so what I would say to members, if we didn't answer your question online here, if you have specific questions about your own circumstance or your own accounts with us, please do give us a shout. Those investment advisors that Tammy spoke about they're waiting here to take your call. So and there's no cost to access them. So please do give us a shout, and we can answer those questions for you. And just finally, I guess on behalf of all of us at CSS, I want to say thank you for joining us today. Hope you got some value from the presentation. I see a lot of applause emojis floating by the screen, so that's great. That's great to see. We really do appreciate the opportunity to serve you and to engage with you like we did today. So if there's any feedback that you have for us, I guess I should say that we do plan to send out a post-event survey as well. So please do give us your feedback. We do take that and try to refine and incorporate that into future presentations that we're doing. And so, yeah, we look forward to receiving that. So have a good evening. Hope it's not too smoky where you are. And thanks again for joining us today.
Thank you. Bye now.